Linear regression indicator. The linear regression indicator is used for trend identification and trend following in a similar fashion to moving averages. The indicator should not be confused with linear regression lines, which are straight lines fitted to a series of data points. The linear regression indicator plots the endpoints of a whole series of linear regression lines drawn on consecutive days. The advantage of the linear regression indicator over a normal moving average is that it has less lag than the moving average, responding quicker to changes in direction. The downside is that it is more prone to whipsaws. Linear regression indicator trading signals. The linear regression indicator is only suitable for trading strong trends. Signals are taken in a similar fashion to moving averages. Use the direction of the linear regression indicator to enter and exit trades, with a longer-term indicator as a filter. Go long if the linear regression indicator turns up, or exit a short trade. Go short, or exit a long trade, if the linear regression indicator turns down. A variation on the above is to enter trades when price crosses the linear regression indicator, but still exit when the linear regression indicator turns down. Example: Goldman Sachs is displayed with 100-day linear regression indicator and 300-day linear regression indicator employed as a trend filter. Go long, L, when price crosses above the 100-day linear regression indicator while the 300-day is rising. Exit, X, when the 100-day linear regression indicator turns down. Go long again at L, when price crosses above the 100-day linear regression indicator. Exit, X, when the 100-day linear regression indicator turns down. Go long, L, when price crosses above 100-day linear regression. Exit, X, when the 100-day indicator turns down. Go long, L, when the 300-day linear regression indicator turns up after price crossed above the 100-day indicator. Exit, X, when the 300-day linear regression indicator turns down. Bearish divergence on the indicator warns of a major trend reversal. Linear regression indicator setup. Setup for the linear regression indicator is simple. The default time period is 63 days. This can be varied between 14 days and 300 days depending on the wavelength of the trend you are tracking. See indicator panel for directions on how to set up an indicator. Linear regression indicator formula. The formula uses the sum of least squares method to find a straight line that best fits data for the selected period. The endpoint of the line is plotted and the process repeated on each succeeding day. Description: the linear regression indicator plots the ending value of a linear regression line for a specified number of bars, showing, statistically, where the price is expected to be. For example, a 20-period linear regression indicator will equal the ending value of a linear regression. How this indicator works: the interpretation of the linear regression indicator is similar to that of a moving average, although it does have an advantage when compared to a moving average. Instead of plotting an average of past price action, it is plotting where a linear regression line would expect the price to be, making the linear regression indicator more responsive than a moving average. Calculation: each point in the linear regression indicator is simply the endpoint of an n-period linear regression trend line. This indicator displays a fan using a linear regression fit to the price as a base. All lines are equidistant and are drawn from the first point of the linear regression to the most recent point of the linear regression plus the root mean square deviation, RMSD, multiplied by a certain factor. Settings: length, look-back period for the linear regression. Multiplier for the RMSD, allows returning wider fans. Lines per side, number of lines on each side of the fan. SRC, input source of the indicator. Usage: traders often use the lines of fans to determine significant points of support or resistance at which they might expect price variations to reverse. The length can be adjusted so that the starting point of the linear regression is located at a pivot high/low.